There's one number the Federal Reserve watches more closely than anything, and most investors may not have even heard about it or even know how it works. This number is called the PCE Price Index. And believe it or not, this quiet little data set can send gold prices soaring. And if you stick around to the end of this video, I'll show you how this week's PCE could be a big catalyst for gold prices moving forward. So what exactly is this PCE? The Personal Consumption Expenditures Price Index. Try saying that quickly. Think of it like the government's official yardstick for measuring inflation, but with a twist. See, unlike the more famous CPI, Consumer Price Index, you might have heard of, the PCE looks at what consumers are actually spending money on, and it adjusts as people swap products. That's the key point. For example, let's just say steak gets too expensive and people start switching to buying chicken. The PCE captures that, where the CPI doesn't. That's the key difference, and that's why the Federal Reserve pays very close attention to this index. Now, there is two main types of PCE indexes. There's the main headline PCE index, and there's also the Core PCE index. The Core PCE index is essentially the PCE index, but without food and energy prices. The Federal Reserve tends to focus more on the Core PCE index. But anyway, here's where it gets really interesting. The Federal Reserve bases huge amounts of its policy on this number. If the PCE, for example, shows inflation is cooling, well, the Fed feels more comfortable cutting rates. But if it's heating up, they hold back or even tighten policy. And as you probably know, gold and interest rates are locked in a tug of war. But which way does it pull? I'll explain in a moment. Here's the connection. Lower PCE means cooling inflation. Therefore, the Fed may cut rates. That weakens the US dollar. And that historically sends gold prices higher. However, if the PCE is higher, in other words, hot inflation, the Fed stays tough. Therefore, the dollar remains strong, and gold, as a result, often struggles. But of course, it's not always that simple, because traders don't just react to the number itself. They react to whether the price is higher or lower than expected. And that's where gold often surprises people. Professional traders even front-run this by watching bond markets and futures contracts. What they're looking for is how expectations shift right before PCE release. Now, if that sounds too complicated, don't worry. I can do a much deeper dive into this if anyone wants it. If my one loyal subscriber wants me to make a video on anything, please let me know and I will. Or if anyone else is watching, let me know what you'd like me to cover and I'll get back to that. I definitely enjoy making a video if I know I'm answering someone's question. But anyway, for now, let's just stick with the basics. As an example, earlier this year, we saw gold spike after a cooler than expected PCE reading. Markets instantly started pricing in a Fed rate cut and the dollar dropped as a result, and gold took off. But here's the cliffhanger. What happens if Friday's PCE release surprises everyone the other way? Now that could send shockwaves through the gold market, and you need to be ready. So subscribe to this channel and I'll keep you updated all along the way. So the takeaway is the PCE isn't just some random boring government number. It's a key domino that can tilt the entire gold market. And here's the key part you need to remember. Gold doesn't just react to inflation itself. It reacts to how inflation changes the next Fed move. Thank you for watching.